Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Randy Frederick, Managing Director of Trading and Derivatives at the Schwab Center for Financial Research, to discuss if stocks could continue climbing the wall of worry in the second half of 2023. Randy, it's great to see you as always. Welcome back to Trade Talks. And first half of 2023, all indexes up, earnings beat, all, growth slowed a bit, but financial conditions remain steady with inflation and rates pulling back. Do you think the second half of 2023 could see the same trajectory, even though a lot of the same risks exist?
Yeah, well, that's a great way to put it, because it's pretty impressive when you think about where were we at the end of Q4 of last year. Virtually everyone was expecting some kind of a recession, or at very minimum, some kind of a market correction in the first half of this year. And frankly, we just didn't get it. But some of those really negative catalysts, like the debt ceiling battle that was going on in Congress, and some of these other issues, frankly, they've all been resolved. So I would argue that, yes, some of the same concerns are there. Obviously, inflation, although we've seen it come down now for 7 consecutive months. The potential for higher rates, which we've now seen it level off. We finally got a pause on rates for the first time in 15 months. So we are looking at a potential for a couple of more hikes this year. Not surprising. That's consistent with what Jay Powell and the Fed has been saying all along. So if you look at the list of concerns overall, I would argue there might be slightly fewer concerns right now than there were then. A couple of things that I think are worth noting. GDP is expected to be positive, somewhere between about 1.5% and 2% for Q2. That will likely provide some sort of momentum going into the next quarter. The official definition of a recession is not 2 negative quarters of GDP. That's true in other countries of the world, but not in the United States. The interesting thing is we had that in 2022. First and second quarter were negative. And yet the NBER, the National Bureau of Economic Research, never officially declared a recession. Now, they're notoriously late in doing so, but now that it's a year after the fact, I don't think that's going to happen. So from my perspective, to get an actual recession, we're going to have to start with at least a single quarter of negative GDP. That's not going to happen in Q2. And I think, frankly, it's too early to know whether that's going to happen in the next couple of quarters. There is an expectation for a downgrade in earnings. We're expecting more than a 6% decline in EPS growth year over year, but there was a negative expectation in Q2 and in Q1. It actually ended up being far less negative than expected because it tends to outperform most of the time.
Do you think measures of volatility are too low given where interest rates are and the potential risk of recession?
Right. So we saw volatility in terms of the VIX index around 20, virtually the first half of this year, or well, I shouldn't say the first half of the year, but this year up until we got a resolution on that debt ceiling. And then volatility came down very quickly and has now leveled off in sort of that 13 to 15 range or so. Historically, this is shocking to a lot of people. They will cite the average VIX for its 30-year history at around 19.5, which is correct. But you have to consider the fact that that is skewed very much to the high side by very large spikes caused by things like, the credit downgrade, the COVID bear market, the internet bubble bear market, the great financial crisis, those sorts of things. If you do a more valid calculation of what is considered normal volatility, which is the statistical mode, believe it or not, it's around 12.5. So from that perspective, volatility right now is actually fairly normal. It only feels low because we've seen elevated volatility for quite a while. And in fact, at that level, the expectation or the implied move in the S&P 500 is around 32 points per day. Well, guess what? If you go back and look over the last month, that's about where we've been. So it isn't really that far out of line, I don't think.
From a technical perspective, with the tech sector continuing to outperform, what are key levels that you're watching in the Nasdaq 100?
Yeah, so the Nasdaq 100 obviously has been spectacular this year. We've had 3 sectors of the market, communication services, consumer discretionary, and technology, that have vastly outperformed the other 8 sectors of the market. And certainly the Nasdaq is very tech heavy, as you know, Apple, Amazon, Microsoft up at the top there. I would be focusing on things like, it's obviously well above the 50, 100, and 200-day moving average because of how well it has performed thus far this year. But I would take a look at like around the 13,600 level, which is the 10% correction line. As long as it can hold above that, we're in fine shape. And in fact, I would think that actually believe we are sort of due for some sort of a pullback right now across the broader market. Maybe not bear market by any stretch, and maybe not even quite correction territory, but something in the 5 to 10% range here over the next week or 2 or 3, I think is very realistic. But if we stay well above that correction line, I don't think there's really a whole lot to worry about. Interest rates are leveling off, and as long as people maintain their jobs, the one point I would make is this: next week, Friday, when we get the jobs report, it's the first one that I'm actually expecting to see some deterioration. The reason I say that is because we've had 3 consecutive initial jobless claims that have shown an uptick for the first time in a very long time. And that tends to translate into a slight uptick in the monthly, which is the more lagging data when we get that. So I would say there might be some volatility at that point in time, and perhaps that's the catalyst for a little bit of a pullback. But the longer term trend looking out the rest of this year, frankly, I think is still pretty positive.
All right. We appreciate the insight as always, Randy. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
You're welcome.